Thank you very much. I feel very honored to come here, and I'm impressed that so many came here despite very strong competition from the good weather. So I am going to spend the next 45 to 60 minutes talking about what you see here, stock picking, how to pick the stocks that go up and not those that go down. Because if you are going to invest in the stock market, it's an advantage over time to be invested in the right shares. And how do you find it? How difficult is it? I'm going to tell a little about that. That will be the main focus of this event. And please tell me if I talk too low, if I need to raise the voice. Can everyone hear me clearly also on the back? That's good. Yeah, just a few words about myself. Here you can read it. I come from northern Norway, but I live here in Vilnius and work here. My main focus has over the last 20 years been on the stock market as a financial analyst and now as an asset manager. In Norway, people know me because every Monday in the Norwegian Financial Daily, I write a full page there where I comment what's happening in the economy, what's happening in the financial markets, and also give concrete recommendations on which stocks to buy. And those recommendations have done very well over the years, so well that like 1.5 years ago, that newspaper wrote that I'm the best stock picker in Norway. That is of course not true. I'm not the best stock picker because there are a lot of stock pickers who are much better, but they don't want publicity. So you can say that I am the best stock picker of those who are good at picking stock, but at the same time don't mind publicity like this. Many investors, they prefer to keep a low profile. A few words about the company where I work. It is an asset management company. We manage other people's money. We have mutual funds. Why do people invest in the mutual funds? Simply because they want good return on their money. Better return than the 0.5% or 1% you get per year in the bank, for example. And why do they come to exactly Dovre? Like there are thousands of mutual funds to choose between. It's such an overcrowded market. And you know, I think we're a niche player. We know a lot of things about some special areas. The thing that we are unique about in the asset management area is that we have launched a mutual fund that invests into Scandinavian equities, and the strategy is to invest into those companies with primary insiders. That means management, board members, those that know the company really well, they have invested their money themselves. As far as I know, it's the only fund in the world that has such an investment strategy. We are small, we are 7-8 people, we've existed for 2 years. We focus on getting clients in Norway and in Lithuania, and our focus is on the normal people. Like if you are a normal person and you want to invest into equities, then mutual fund is the best vehicle for that. Our main fund was started a little more than a year ago, and it's already performed very well. It's up 38.62% measured in litas over the last 14 months. But as we all know, past performance does not guarantee future performance. So how it will be in the future, I don't know. Now I'm going to tell a little about probably what you're interested in and why you came here. The stock market. You know, the stock market is, you know, we all heard about Warren Buffett. He invested into stock and he got became like the second richest man in the world. I think we all wouldn't mind to become the next Warren Buffett. Maybe I think we don't necessarily have to be filthy rich like him, but even if we had a tenth or 100 of that, I'm sure most people would be pretty happy still. So in the stock market, you can get superior returns if you are smart. Superior returns, which compounded over many years, can make you filthy rich or wealthy, depending on how good you are. But if you are only in the stock market for the money, if that is the only motivation, you'll probably not succeed. It's like a lifestyle. You have to like it. It's like a sport. It's like a hobby. Some people, they like to dance. Some people like to play chess. Some people like to go to casino. And some people like the stock market, like me. And you know, the good thing is that if you are going to play chess professionally, then first you have to start at a lower level. And then if you win all matches, then gradually you can play against better and better players. And then maybe in the end you'll be playing against the best chess player in the world. In the stock market, you can play with the best people. Because when you buy a share, there is someone on the other side of the table selling that share. And there's a good chance that that is someone quite wealthy, quite smart, who's taking the opposite bet of yourself. And the point system is very, very simple. Either you win money or you lose money. But there is one big difference between chess and the stock market. And that is that while you're playing, the rules are changing and no one tells you that they have changed. So actually you never get fully educated. If you find some market inefficiency, let's say you discover that, you know, every Christmas and New Year there is a rally in the market, some seasonal market inefficiency. If this becomes widely known and exploited by a lot of people, that market efficiency will cease to exist. And that's how it is in the market. You know, it's a lot of people who are greedy, who want to earn money, who try to find every new market inefficiencies, exploit them for their own profit. And markets are all the time changing. The rules are changing. Once you learn the rules are changing. And that makes it extremely fascinating. You learn every day, every year, no matter how long you have been in the stock market. Yeah, I'll just tell a little about this. Do we need stock market? Do we need investors? Do we need people like me? Or is it enough if we only have doctors, engineers, farmers? So I guess these things here, most of you know. You know, the role, the function of the stock market in the, you know, modern economy. For those who save money, if you look at the US, where you have a big database going long back, if you look at like the four main financial asset classes: gold, cash, That means maybe like 3-month treasury bills, long-term bonds, like 10-year government bonds in the US, and equities, which have been doing best over the last 200 years. Without any doubt, without any competition, it's equities. Equities is a superior investment if you invest long-term. It gives, like, on average 6% more than saving in short-term, secure, interest-bearing instruments like government T-bills. And 6% extra return compared to having money in your bank, that makes a quite big difference in a 10-year time horizon or 20. The worst investment has been gold. Gold only rises in line with inflation over time. You have periods when it rises faster, like the last 10 years, but after that you usually get a mean reversion and it does worse. The second best investment is long-term government bonds, and then you have the cash. And why is it like that? You know, equities, it's the most risky investment. You know, there are years when the stock market can fall 40 or 50%. If you have your money put into the bank, that will not happen to you unless the bank goes bankrupt. And no one would put their money into the stock market and take such short-term risk unless they would get compensated through excess return in the long run. So, you know, if you have money to save in the long run, you know, you should focus on the equity market. To have long-term savings in the bank, that is suboptimal. And then on the other hand, like for the companies, the stock market has an important function for them to raise equity needed for expansion. Here in Lithuania, the stock market is not functioning. You know, if you have a company that is going to be the next Apple or Facebook, they can't go to the Vilnius Stock Exchange and raise $1 billion. They probably have to go Poland or somewhere else. But in general, in a modern, well-functioning economy, the stock market provides companies that are like lucrative, that are like expanding, provide them with the equity they need to finance that expansion. But not only that, for example, over the last few years, we see that banks, they have become more hesitant to borrow out money because you have Basel III. Banks don't have enough equity, so they need to cut down on the credit growth. And also the financial markets, for example, this is an example from Norway, like the bond market, how much money is raised through the bond market to private companies. These numbers here, just to put it into perspective, this is like 20 or 30% of GDP per year. So for large private companies, they don't borrow money in the bank. They borrow it in the financial market through bonds. And if they need equity to build a factory or to order an oil rig or buy new airplanes, they get the equity through the stock market. So it's a little hard, like in a well-functioning capitalistic economy, to imagine that without the stock market, without the well-functioning capital markets. And that, I think, will be the next step here in Lithuania. The ecosystem and the financial market, it's very small today, but I'm sure in 10 years you will see that they have developed substantially, and there will be many attractive job opportunities for those who have interest in financial markets. It's needed. And do we need investors or speculants or whatever they are called? What is the job of people like you, me, who buy and sell shares? Like our job is to help with the price discovery. If a share is undervalued according to the fair value, intrinsic value, then we buy it, and through buying it we help push the share price up. And if the share is overvalued according to fundamental analysis, we sell it and help push it down towards the fair, correct, right value. That's the essence of price discovery. And it's asset managers like me, it's investors like some of you who contribute to that market efficiency, to that price discovery. And actually, you know, if you think a little hard about it, like if you call around to all company owners in Lithuania and ask them, like, tell me about what opportunities do you see for the company? If you had access to capital, what would you do with it? Which investment opportunities do you see? Would you build another factory? Would you build a 4G telecom network or whatever? And then almost all companies will say, yes, we have profitable expansion opportunities. If I had access to capital, I would do this and that and that. And if you summed up how much capital they would need to finance that expansion and compared how much capital exists in Lithuania today in bank accounts and other places, you would see that, you know, the demand for capital is higher than the supply for capital. So capital is a scarce factor. It's always bigger demand for money than it is supply. And then the question is, like, you have one company who want to build a shoe factory, and then you have another company who want to build like a dairy to produce cheese. And if you have a situation where there's not enough money in society that you can finance both these projects, who should get the money? And here the stock market comes in. Because, you know, if you think a little hard about it, the share price of a company, it reflects the cost of capital for that company. For example, if the share price is low for a company, the company will have to print a lot more shares to get in a given amount of capital than if the share price is high. So that means that if the share price is low, the existing owner will suffer a much higher dilution cost than if the share price is high. So, and you can prove theoretically that if all shares are trading at their fair fundamental value, intrinsic value, then the capital will automatically flow to those companies, to those projects that generate the highest return on investment. And that is quite important, because if you think a little, like, what makes a country rich? Of course, the workers have to be productive, but also the capital stock in the society have to be as productive as possible. Because if we only, like, misinvest, malinvest all the capital stock in building factories that produce things that no one wants to buy, that's a quite big economic loss and a wealth loss for society. So, you know, here the stock market comes in, and in a way, through that invisible hand, decides which projects should get funding and which should not. The alternative would maybe be, for example, to have a centrally planned economy where some bureaucrat in some department will say that, okay, now we're going to build that shoe factory instead of that cheese factory, because according to our 5-year plan, we will need more shoes, while we don't need so much cheese. And that is normally not a better model than letting the financial markets handle that. So this was a little like theory. I just want to say that, you know, if you invest in stocks, don't be ashamed of it. You're not a speculator. You're not, you know, it's like if you are able to make yourself rich through the stock market, you're also contributing to price discovery, market efficiency, market liquidity, and so on. And that is also a good thing for the economy as a whole. Because I'm sure that if you're going to tell your grandmother or someone, like, you know, I am buying shares, then many will react a little negative. Oh no, you're not like them. Can't you get a decent living? Can't you become a doctor and cure people, or don't speculate? But the stock market is not like going to the casino. The casino has no economic value. The stock market is important for the economy. Many people mix up and think that, okay, the stock market is some kind of casino. It's not. If you shut down all casinos, you know, the economy would still function at least as good as it does now. There will be no loss of wealth in society. But if you shut down the financial markets, there will be all kinds of problems. It would be like, it's very hard to say in which way it would hurt the economy. But it would hurt the economy through maybe 1,000 different ways. But I'm sure those who invest in the stock market, they don't think so much about now I'm going to contribute to optimal capital allocation in the economy, now I'm going to make, you know, this Lithuania a richer country. What drives people mainly is to earn money for themselves. That's why people invest in stocks. They want to become the next Warren Buffett, or maybe the next mini Warren Buffett, or, you know, it's the money. It's all about the money. And it's not easy. To earn money is never easy. To earn money if you run a restaurant is difficult. To earn money if you run a cheese factory is difficult. There is no reason to believe that it should be easier to earn money in the stock market than in any other business. So first, have in mind this is really tricky. And most people who are in the stock market, they want to do better than the average. They want to beat the index, beat the benchmark. But remember that all investors, they cannot beat the benchmark. All investors cannot be better than the average. If you want to be better than average, you have to get yourself some advantages that the average investor don't have. And let me make an example. Let's say that you're having a restaurant and you have the goal to make the best food in town. How can you do that? Well, one way would be to hire the best chef. Another strategy would be to buy the best commodities, the freshest fish, the freshest vegetables. In the stock market, the chef, you know, that can be compared to the analyst, who is better at digesting, analyzing the publicly available information. While the commodity in the stock market, that's information. So either you can go for the chef strategy, become better at interpreting everything, or you can try to get an informational advantage, have superior information compared to the average investor. Let me talk first a little about that thing with superior information, because that's an important point. Because normally, if you do an investment based on superior information, you're breaking the law. That's the definition of insider trading in general. And that's forbidden in the stock market. I think in Lithuania you can get 3 years in prison. In Norway you can get 9 years in prison. But, you know, prisons in Norway are much better than prisons in Lithuania. So I would still say that, you know, probably the punishment is comparable. Actually, you know, the insider trading rules, that is like a specific thing for the stock market. In the currency market, there are no insider trading rules. In the commodity market, there are no insider trading rules. For example, in my next life, I'm not going to be an asset manager. I'm going to work in Pentagon. And then, you know, when Pentagon decides that now it's time to send in the bombers to bomb those nuclear facilities in Iran, the day before, I'm going to buy a lot of futures contract on crude oil, maybe some options, because guess what's going to happen to the oil price when those bombs start to fall. That's an example of a trade based on superior information, and in the commodity market that would be legal. So probably after that I would cash in the profit and I would resign from my job. I would move to some island where they have coconuts and it's good climate, and I would stay there the rest of the life. But unfortunately, I'm not working in the Pentagon. But in the stock market, you have to be careful about basing investments on superior information. But it's possible too. For example, what is clearly not legal? You know, if you know in advance what the quarterly result will be of Theo before it's publicly announced and you trade on it, then that's clearly inside information. If you know in advance that this company is going to be acquired tomorrow and you buy it today, that's clearly insider trading. But for example, let's say that you have invested in some dairy company in Lithuania, cheese factory, and then you call to all the shops that sell that cheese. And like, how much cheese did you sell in the first quarter? And then you call all the shops, and then you get a picture. Then basically you have the revenues of the cheese factory. You call all their clients and you know how much they bought. Is that insider trading? Actually, that thing there, that is called like, you know, a check of the pipeline of the company. When you do a pipeline check, you call all their clients, and then you add it up, and then you have a good indicator on revenue and profits that quarter. That is not defined as insider trading. But obviously, you know, if you had such information when doing a trade, then of course, if you know more than the average investor, because you did such a pipeline check, obviously that would increase your odds of doing the right bet in the stock. Don't you agree on that? So you can go in that direction, try to, you know, get an informational advantage. In Dovre, we are using a variant of the informational advantage strategy. And let me see here the next foil. Yes. You see here. You know, when people in top management and board invest in their own company, buy shares in their own company, the primary insiders as they call, you know, they are not allowed to buy the share if it's like undisclosed, very price sensitive information. But if it's not, then they can't buy. And for example, if you see the CEO of Theo buying a lot of shares in his own company, you know, he will always know more about Theo than all of you who sit here, I'm sure. If he don't know that, he is not doing his job and he should be fired. And when he does that trade, he's by law required to disclose it, that yesterday I bought this and this many shares at that price. This is quite normal. So these primary insiders, they have an informational advantage when they do investments. And if they have this advantage, it would be natural to assume that they would be better investors than the average. I mean, the CEO of Theo should be better at trading the Theo share than most others, for example. And in the 50s and 60s, this was like a hot topic. Financial theory says that top management and board members, they have an informational advantage. So because of that, they should be better investors than the average investor when they do trades in their own stock. But is it like that in practice? And it was a lot of empirical studies done at universities, mainly in the US, on that subject. And they actually confirmed that this is how it is. You know, the the prediction from financial theory, it actually is working in reality. Because as long as there is an information disequilibrium between the inside of the company and the outside of the company, the insider should always have a slight edge. And it's impossible to have a complete equilibrium in information. So I told you that, you know, in the stock market, things are changing. You know, once the rules are discovered, then the rules change. But this thing related to trading of primary insiders, in a way, it's so close to the DNA of the market that, you know, that thing can't mutate or change. That thing will basically always work to a bigger or larger degree. If insiders is ever going to be no better than an average investor, that means that there is no difference in information between the inside of the company and the outside. It's very strange that no asset managers thought of this and set up a mutual fund who use this market inefficiency, who use this investment strategy in a way to harvest the information profit that the insiders have. So like in our office, when I come to work in the morning, then we have people who goes through all stock market messages in the morning, see like, okay, these insiders bought in these companies in Norway, and then in Denmark, and then in Sweden, and then in Finland, and then we make investment decisions based on that. The insiders know best. If the CEO of TO is buying shares a lot himself for his own money, you know, even if some stock market analyst says that TO we rate as a sell candidate, I trust more the CEO of the company than any analyst. I mean, following the insiders, this is so easy that even my grandmother could do it. The core competence that it requires, that is the ability to read, which most people possess these days. And it works. It creates superior long-term investment returns. But it's a little boring. And, you know, I'm sure you guys, you know, it's also interesting to use the brain a little. If you only sit there like a robot, okay, insider bought in that company in Sweden, in TeliaSonera, so now I'm going to invest some of my money in TeliaSonera. And then someone bought in Nokia in Finland, so now I'm also going to buy a little. Like, this is a little boring, because you don't use the brains. Basically, you're just a monkey who is like copycatting the primary insiders. Of course, you get rich in the long run from doing that. But, you know, you use maybe only 5% of the brain for that. And that's not interesting. And that's where the analytical approach comes in. Because there it's not enough to use only 5% of the brain. If you want to get rich, that's a much more tricky, difficult game, and a much more interesting game. I mean, if you follow the insider strategy and you get rich, it almost feels a little undeserved, because you really didn't, you feel like, okay, this money I don't deserve because I worked so little for it. But if you use the analytical approach, then I guarantee you're going to sweat, you're going to sit weekends, day, night with Excel sheet and scratch your head, call around, try to understand the company, try to make a evaluation of the company and an investment decision. That is really mentally challenging. This is like Olympics, you know, in chess. Here is the chess game that I talked about. This is the funny part. This I like a lot. You know, those following insiders. There we have like a few people in the office who do that, and my role is mainly like oversight and following a little from the sideline. But the analytical part, that's really fun. Yeah, so this I think is not breaking news. All companies, they have a fair value, a correct fundamental value, an intrinsic value. Many people think that, when I buy a share, then it's something like immaterial, something special. But when you buy a share, you should not think as I am buying some electronic registration, or you should think as if I'm buying the whole company. So for example, if you have a share that is at 9 liters, which implies, let's say, a market capitalization of 100 million liters for whole company, you should think like, okay, if the bank would give me a loan of 100 million liters, would I buy the whole company if I could? And of course, if you're going to take a loan of 100 million liters, then I'm sure you would do some research on this company first. You would check like, how is the management? Are these criminals or are these clever people? What about the sector? Do I believe in the sector, like industry? Do I think it's the right time to invest now, or are we going to get a new financial crisis? And then you will look very deeply into the fundamentals of the company. How do the accounts look? Does this company generate cash? Is it profitable? How does the future look for this company? And then you would try to make a valuation of the company. Some people say that the stock market is always right about the company. I believe that the stock market is always wrong. The question is just how much wrong is it? Is it like 1%, 5%, 10%, 100%? And to find the right value, we need to do that kind of valuation, which is written here. Just follow the textbook. It's that simple. It's that difficult. Some people, they, start analyzing Apple Inc. Like now it's not the world's biggest company, but it was not so long ago. And they try to make a valuation, and but think a little like what you're looking for in the stock market. That is companies that deviate significantly from the fair value, from the economic value, intrinsic value. Like in a company like Apple, all the cards are on the table. There are like so many analysts in investment banks who follow it on a daily, hourly, minute basis, produce a lot of research, analyze up and down, do pipeline checks, talk to competitors, analyze technological trends. It's like it's been chewed so much that what is the chance that the market fails to discover the true price of Apple Inc. with so many people studying it so hard? It's not such a big chance for that. It's a little like when you search for gold. I mean, then you usually go to some river, you have this washing pan, and then you dig up some, and then see if there is some gold. And of course, if you go to somewhere where it's like been 1,000 people before you searching for gold there, you will probably not find a big piece of gold. Maybe you'll find some small dust of gold. But typically the big deviations, the big anomalies, the big mispricings in the stock market, that is in the companies where like no one cares, no one focuses, no one are interested. So like myself, I am very interested in the companies that no one else are interested in. If everyone else is interested in a company, I am not so interested. Because, it's even been done some academic research on this, like market efficiency, the market's ability to discover the true price. It's typically proportional to how many people analyze, follow, watch the stock. So for example, this saw some one academic report like if from the US, if a company is followed by 3 analysts or more, then there is market efficiency. Then the share price generally reflects the fair value. And it's random, random walk. But if it's less than 3, then the price discovery process sometimes breaks down. And that's where the opportunities lie. So, when you look for good investments, you look for companies that either look cheap based on the earnings or look cheap based on that they have some asset values. Like maybe it's real estate companies with some big values in real estate that are not properly reflected. And then you look for as big deviation as possible between the market price of the company and the real economic value. Go for a big safety margin. If you find a company that, okay, you calculate that the share price should have been 11, but it's like now 10.50, so it's like a 5% mispricing according to your Excel sheet. Maybe it's not a mispricing, maybe it's just you have some wrong input in your Excel sheet. You basically have almost no error, margin of error. But for example, if you have a mispricing that is in the order of 50 or 100%, like the Excel sheet says that this share should be 2 litas instead of 1, then, that sounds like that it can become a really good investment. Focus on value. There is no law of nature that says that an undervalued stock has to be repriced tomorrow and then it will go for fair value. Undervalued stocks can stay undervalued for eternity or quite a long time. But if you systematically buy undervalued stocks, you will do well and achieve excess return over time because the stocks tend to over time gravitate towards their economic fair value. You just have to wait. You never know, will it happen tomorrow? Will it take 3 months? Will it take 3 years? But, if you believe that water runs downward and not upward, if you believe that, then you should also believe in fundamental analysis and that stocks over time gravitate towards their economic fair value. And believe me, water is running downward. No doubt about it. So, how does this work in practice? What factors should you consider? For example, when I look at a company, these are some of the things I look into. For example, who are the people behind the company? Who are those main shareholders? Who are the people in the board? Who are the people who are in the top management? Are these people who have a track record of failure or a track record of success? A track record of over-promising and under-delivering, or the opposite? And then I look a little do I believe in this sector? Do I believe that cheese is a sector that will expand and be lucrative over the coming years? Or will people stop eating cheese in the future? If I, for example, look at a cheese factory or cheese producing company. And then I look is this company having some lasting advantages compared to the competitors? Is it a market leader and therefore has economics of scale that the competitors don't have? Is it a cost leader, for example, because of innovation, another way of operating? Or have they found a niche where basically they are alone and no one else bothers to be there? Over time, it often pays to choose companies that have some edge over competitors. And then I look a little at how is the market structure. Is it a highly fragmented market structure? For example, if you look at the travel sector, the airline sector, if you look at the accumulated profits of the airline sectors the last 10 years, I think they've been losing money each single year, 10 years in a row at least. So it's not a lucrative business. And why is it not a lucrative business, the airline sector? It's because it's low barriers of entry, it's highly fragmented. All you need to start an airline company is some money, and then you can buy an airline, and then you're basically in business. And also they're close to the price-sensitive consumer in the value chain. So, it's very hard to get a good return on equity in such a sector. But look at another part of the travel industry, the cruise industry. Have you checked the accounts of, for example, Carnival in the US? They are profitable every single year. Even in 2008 and 2009, during the worst of the financial crisis, they managed to earn money. And why is that so? Airlines don't earn money, and cruise ships earn money. And it has a little to do with the market structure. Like basically, the cruise industry it's a duopoly or oligopoly. It's like 2 or 3 players that dominate the market. It's huge barriers of entry. Like if you want to start a cruise company today, you probably need like 4, 5, 6 cruise ships to get the economics of scale, and each cruise ship will set you back close to $2 billion. So you will need at least $10 billion to start such a company. And no one, if I go to Wall Street and say that cruise industry is very attractive, it's an oligopoly and it's high return on equity, give me $10 billion, I'm going to start a cruise company, no one will give it. That's the problem. That's why it's better to be shareholder in the cruise industry than in the airline industry. And then you start to look at the company specifics, like what is the fundamental value of the company, you do a discounted cash flow and so on. And let's say you found a share like that is clearly mispriced. Let's say that you've been studying the Ukrainian stock market, and then you find a company called Myrseth or whatever it's called that trades at a P of 2, which is one of the biggest companies in the country. They produce like helicopter engines. Yeah, it's a huge company, it's a blue chip, P of 2. That's fantastic. Let's go all in and in addition borrow money. But there is one problem. There's one problem. It's someone in Ukraine who owns 87% of that company. And that someone, 87%, he would like to own 100% of the company and take it private. He hates these 13% out there, and he would like to buy their shares as cheap as possible. He don't pay dividends. He don't disclose any information to the market unless what is required by law. So think a little about it. Why should this share trade at PE4 tomorrow or PE10? When you have such a shareholder unfriendly major shareholder. There is a reason why it's PE2. And as long as that reason stays there, it's probably going to be PE2 forever. So it's maybe not necessarily a good buy. So you have to think a little, why is it like that? And for example, in the future, what will it take to create the repricing of the share? If you cannot find any reason why it should reprice, then it's maybe not a good buy, then maybe it's a value trap. And also you should think a little like, why does the price discovery process, why does it not work? For example, if some of you comes to me and says that, last night I was sitting over a bottle of red wine and I did an Excel sheet on Apple Inc. And the market is totally wrong. Apple Inc. should be at least twice as high as it is today. That's what my model shows. Then the question is, how can it be that the market is so wrong? Like, it's so many people calculating on a day-to-day basis, smart people. Like Goldman Sachs, they probably have 3 persons working full-time on only one stock, Apple Inc. That's all they do in their whole life. 24 hours a day following that company, you know, it's not likely that there is a failure of the price discovery process in Apple Inc. So what I would say to you, or you, if you came to me and said that, you know, Wall Street is totally wrong about Apple Inc., the share is mispriced, is that probably like, what did you drink last night? What did you smoke? Maybe you got some high voltage on your computer. Things like that. That's a more likely explanation than that the share is mispriced. So if the price discovery process is going to fail, also find the reason behind it. And if you cannot find any reason why it failed, then probably it's not a mispricing. A more likely scenario is, how should I say, a darker explanation. Like, for example, I've seen in my career as head of research and financial analyst, then I saw some examples of unexplained mispricings in large liquid Norwegian blue chip companies. You had like shares that I looked at the Excel sheet, yeah, you know, the market seems to be totally wrong. And if that share seemed to be underpriced, then the correct strategy was typically short it. If it's like a mispricing and there is no obvious reason for the mispricing, short it. Because what typically happens is that within days or weeks, there is a profit warning. And then you realize that the share wasn't mispriced in the first place. It's just you had way too optimistic assumptions in your Excel sheet. Actually, the share was overpriced. So the likely explanation of that is probably that someone had an informational advantage, things leaked out, someone started selling their shares, pushing the share beyond like fair value based on official information. So don't go into that trap. If you see something that you can't explain rationally, then you know, it's a sign of insider trading. And sometimes you see it. Like often you see that, for example, prior to an acquisition, the share price starts to move up unexplained. But prior to a profit warning, often the share price is weak for several days or weeks ahead of it. And you know, I have a friend who worked in that financial securities police, and I said that, you know, when you see things like that, that means that there's been an information leak here. But the problem is that those who sit there, they mainly have a background from law. They are like 25, 26, straight from law school, and then they don't understand these things. So, you know, the markets are not perfect. I wish I could say to you that it's a complete level playing field, that there is no insider information, no information leaks, but there are. How is the news flow going to be? Like, if you have a company that looks fantastic based on fundamental value, but you know, there are many negative news, like in the short term in the company, that, you know, short-term results will be weak, cheese prices are falling, inventory write-down, like these things normally don't matter much for the long-term fundamental value of a company. Because in a way, like the net present value of the future earnings, like the earnings this year and next year, it's maybe like less than 5% of the total net present value of the company. So if the next 2 quarters will be bad in the cheese factory because there was a drought, there were too little milk, so milk price was sky high, but the cheese prices were not possible to raise, so the cheese factory got into a margin squeeze. You know, if you know that the next few quarters will be really tough, then maybe that cheap cheese or dairy share will get even cheaper before it turns up. So also try to think a little, like it has a little to do with timing. Sometimes cheap shares get even cheaper before they turn. News flow. And then of course, you know, a final check. You know, if you found a share that looks so fantastic and the market is totally wrong about the valuation, why aren't anyone in the management, in the board buying shares themselves? Or are they buying shares themselves? You know, I like to see in undervalued companies that people close to the company, they are buying. For example, if I talk to a management and he's like super confident, this company is going to have fantastic growth, strong profitability, and then like the day after he sells his own shares, then that fails the test. Then I lose confidence. Yeah. Just remember that, you know, this is a tricky game. It's, you know, losses are unavoidable. You know, some people, they are perfectionists. They cannot tolerate being wrong. If you are a perfectionist and want to be right 100% of the time, the stock market is not the place for you. Losses, bad investments, they are unavoidable. Just make sure that, you know, the sum of all investments, that over time the profits are bigger than the losses. But you can never avoid the losses. And also remember that the future cannot be forecast exactly. Even if you've done a fantastic Excel sheet, everything looks super, things can go wrong. I mean, look at the financial crisis. Like, if you have done your homework and you know that dairy better than almost than the CEO of the dairy, and you're sure that this stock is undervalued, like if that dairy is hit tomorrow by a big meteor, still you probably will lose money on that stock. So have that in mind, be humble, some things will go wrong. There is nothing that is certain in the stock market. If someone says to you that this is bankers, this company you can't lose on, it's a one-way ticket, then they don't know what they're talking about. Some of these tickets, they will go sour, it's unavoidable. I was thinking, it's always good to make a practical example. This is a share that we have bought for our clients. And we luckily didn't buy it at 50 kroner, because now it is at 1. But we bought it like a little yesterday, a little the day before, at around 1 krone. It's a listed company on the Oslo Stock Exchange. The name is Interoil. It's an oil company. They're producing oil in Colombia and Peru. And I can give an example. Why did we buy it? Why do we like it? Why do we think the share is mispriced? When we calculate the valuation today of the company, this company, they are in 2013 going to produce approximately 3,600 barrels of oil per day. And with the present oil price, that implies a price earning of 2.3 for 2013. That sounds pretty low, doesn't it? And next year the company guides increasing production to 4,600 barrels a day. Then the price earning will fall to 1.0. So that means that the profit of the company will be equal to the market cap. The market cap of this company, it's a little more than 100 million liters. So normally if someone came to me and said that, okay Stig, this is a company of price earning of 2, falling to 1 next year, I would say that, this is too good to be true. What's the catch? And there has to be a reason, like, for example, I can explain you, like, why the market pricing mechanism failed and this situation arose. I believe it's a mispricing. this share is a good buy. You know, the company here, they have historically consisted of two parts. They've had like onshore oil production in Colombia and Peru, like nothing fancy schmancy, just drill into the ground and then it flows some oil, old-fashioned oil production, not deep water, not shale. So they had like a cash flow of a cup $10, $20, $30 million a year from that producing assets in Latin America. But then the management of the company decided that we are not going to, this money here, we are going to reinvest in the oil industry. But we are going to spend this money offshore West Africa. We are going to search for oil offshore Angola, drill deep water wells, which are hugely expensive. And then the problem was that these wells, this exploration program was super costly and it failed. And then the company got into an interesting situation. They started to get liquidity problems. The losses from exploration in Western Africa was higher than the cash flow generated from these things in Latin America. Normally the company would then like go to the stock market and raise equity. But then the shareholder, the biggest shareholder, he was, no, I don't want to be diluted. Let's not do that. Let's instead try to conserve cash by stopping drilling more production wells in Peru and Colombia. Let's cut the capex there until our liquidity in the company improves. And the problem is that, you know, these wells that they have there, they don't produce that much oil. They like have many wells producing like a few hundred barrels a day, and they have a decline rate of 2.5% per month. So when you stop drilling new wells, your production actually starts falling. And that is a little like if it's a cold winter night and you're cold and you're peeing in the pants. It's not a good strategy, because what happened like in Interoil was obviously that when you stopped drilling new wells, the production started falling, and that started to impact future profits negatively. And then another problem with the company was that they had debts. They were quite leveraged because the previous management were super confident that we'll strike gold offshore Angola, which most have done except them. And the problem was that the debt was rather short term. It was like bond debt with short maturities. And then, you know, the problem was that, you know, the company tried to refinance it. And then they came to the middle of March, and they had like a $10 million bond debt maturing like 20th of March. And like 15th of March, the board said that, you know, this is not going to work. We're not going to get this refinanced. We're going to go bankrupt if we don't get money fast. And then the board went to investment banks and said that, you know, we have a liquidity issue, we need money fast now, because in 5 days we are bankrupt if we don't get $25 million quickly. And then what happens is that, you know, the investors, typically institutional investors, people like us, special situation funds in London, US, they start to smell blood. You know, so what Interoil board discovered when they started to do roadshow and talk to investors is that, you know, we have a super weak negotiation position. We are bankrupt in 5 days. And those funds, they know it. They know that we have actually, like, have to accept any bid that we get. So, like, the company was hoping to do the share issue at maybe 6 or 10. But then the investor said that, okay, we'll give you $25 million, but it's not going to be 10. It's going to be with a 1 number, but not 0 behind. So then the board had, okay, $25 million at 1 krone, take it or leave it. And what do you think the board did? They had 2 choices, take it or declare bankruptcy. So they took it. And now the new shareholders, they have 80% of the company, while the old one got diluted to nothing, despite the company like being profitable, positive equity and so on. But they were risking liquidity, bankruptcy. So you had a highly distressed situation, and when a company is facing liquidity bankruptcy, then in a way no value for the share is low enough, because once you stop paying your debt and the creditors call to the court, then it's the creditors who decides what is happening in the company, and you are probably not going to get any money ever. Then it's better to sell at one, even if it's low, than to get your shares totally wiped out. So typically, like if you have a distressed situation, the value can get very low. And that's the issue here. The value of the company got crushed because it was actually, the company was just actually days away from bankruptcy. And the fund managers, they smell blood. This is a micro cap in Norway. It's only one analyst to follow it in Pareto Securities. And he is now in a blackout period. He's not allowed to publish any research because it was Pareto who did the share issue for the company. Right now it's no one following it. So you can say that before the equity financing, before they got the $25 million, the share was not cheap at one because the company was about to go bankrupt. Now it's not a distress situation. The liquidity of the company is very good. They got in the money, but it's like a couple of weeks ago since the share issue was done, and you know, what was happening is that, you know, a lot subscribed here, and then when they could sell the shares in the market at like 1.15 or 1.20, many did it. Okay, I've been invested for 3 days, I can sell it with 20% profit. So many who invested in the share issue, they were pretty short term. They were happy to do like 5–10% in a few days. And that supply of new shares has pushed the share towards the share issue price of 1 krone. So I think I understand why the share is, why the price discovery process failed. The price discovery process failed because the company was distressed and was risking liquidity bankruptcy. Now it's not distressed, so the share should be repriced. But are there something that can stop the repricing? Well, you know, for example, if you had that Ukrainian situation with some oligarch owning 87%, that could be an issue. But normally, you know, if a company is trading at a price earning of 1 or 2 for a longer time, and, you know, if the stock market is not willing to value the company properly, then there will be some other who will be willing to do that. Some Wall Street Jew in a private equity company, some other oil company operating in Latin America, the company will be bought by someone. And for example, if you look at the shareholder list here, this is basically all the new shareholders that came in through the share issue. You know, it's fragmented. The biggest shareholder has, you know, way below 10%. There is no one who can prevent an acquisition of the company. And actually it's been acquisition attempts previously at this company. But then you had a dominating shareholder who basically was the cause of this problem, who could block the hostile takeover attempt. But now it's no one blocking it. So, you know, I don't see any barriers to preventing the price discovery process to work again. But it might take time. I don't know, you know. Maybe the share will stay at 1 krone for 3 months, for 6 months, for 12 months. But I believe it's completely mispriced. I believe that water is flowing downward. And as long as water is flowing downward, this share should flow upward over time. But of course there are risks in everything, and I'm not going to spend a lot of time on risk, but don't think that you can buy this share and then you have like a guarantee from me that this is going to flow upward and then you can sue me afterwards if it goes downward. This is a risky company, I mean, this share can triple, but I'm sure also it can go down to zero if it's like a revolution in Colombia, or you never know. Shares always risky.